Let's bring in Anastasia Amoroso, the global market strategist for JP Morgan Funds. Her call is to keep your eye on capital spending. It may start to ramp up. Why?
Because, first of all, it hasn't ramped up to the degree that it really should have, given that we're not just in an economic recovery, we are in an economic expansion. So what's interesting, if we look at percentage of fixed asset investment that we've seen over the last number of years, 5 years, we have significantly underinvested in structures, in equipment, and intellectual property. And we know what happens to those structures. They age. We know what happens to equipment. It becomes outdated. And there is that replacement cycle that should take forth. But I will say there are some good reasons, right, why companies have not ramped up the capex to a greater degree so far. Those reasons, or some of them, was the fiscal overhang, was the political uncertainty that dominated.
Well, so, but, right, these companies, they prefer to buy back shares or increase their dividend rather than put that cash to work.
Or spend the money overseas.
Yeah,
well,
that's
that
right.
too.
You don't make big capital allocations, right, when there is this uncertainty overhang. But I think the other thing, which is actually evident in the earnings so far, even today or over the last few weeks, is that capacity utilization, right? We don't have the same spare capacity as we used to have before. Just earlier, Scarlet made a statement.
So we're kind of maxing out a bit.
Yeah,
okay.
Exactly.
Well, Dixon, you talk to many CEOs around the country. Are you hearing this as well?
Yeah, I think that's a fair and accurate read. I wouldn't differ with much of anything you said. I think it depends very much on where you are in the country, though. Being from the Bay Area and San Francisco in particular, I can just tell you that there's all kinds of money flying around for everything, and it's all different types. It's venture capital, it's growth capital, it's for real estate, and for capital improvements.
Right, but Anastasia, you're talking about like putting the money into factories, putting it into equipment, that sort of thing.
That's right, but I think in order to do that, what Dixon is mentioning is key, right? You have to have residential construction, you have to have non-residential construction, you have to have that, end-user demand, and because that demand is now picking up, that eventually is going to drive those capital goods orders, which we saw yesterday as an example.
That's true. I know, speaking about that outlook and that uncertain economic outlook, Julie, I know you're watching what the Fed is worried about, or what Janet Yellen is worried about.
Well, Janet Yellen is worried about inflation and how to measure inflation. She spoke in a speech last week and talked about how long we're going to see the Fed funds rate at this relatively low level. So in the speech that she gave, she said the slower the projected progress towards the Fed's 2% inflation target, the longer the current target range for the federal funds rate is likely to be maintained. And the Fed, we're not seeing a lot of progress on the inflation front. If you look at PCE, personal consumption expenditures, that price index, which is what the Fed closely watches, it's remained below 2% for 22 months. The problem is both Yellen and a lot of academics have acknowledged that it's very difficult to project inflation, especially in recent decades.
And if we're in an economic expansion, aren't you worried, why aren't we seeing inflation?
I'm actually more worried about when we might see inflation, that we may see unexpected inflation over and above the estimates that the Fed is currently projecting. So the big disagreement today is that are we in this new economic environment where wage inflation does not have the same correlation with inflation as it used to, or are we in this other economic environment where because we have so much slack in the labor market, then that first relationship might not hold as it previously had. So regardless of that outcome, that is subject to the academic studies. Regardless of the outcome, I think if inflation expectations start to unravel, we will start to see yields pick up even before the Fed has a chance to change the policy. So that is a fear of mine.
One simple example of a place where we're seeing a ton of, I think, salary and wage inflation that maybe doesn't get measured by any of the traditional metrics is in the cost of hiring engineering and software development talent. For example, with all the different tech companies that are getting funded in the Bay Area, and I think we might have talked about this before, but you talk to almost all the CEOs there, and they'll tell you that the hiring environment right now for technical people and biz dev and marketing people in venture-backed companies is about as difficult as they've ever seen it.
Now, I know, Anastasia, you're bullish on industrials among other sectors. Scarlett, you've got, though, a bearish case on industrial companies.
That's right, Betty. Just take a look at the deceleration in housing here in the U.S. Demand for mortgages at a 14-year low, and leading indicators like housing starts and permits are softening as well. That's bad news for United Technologies, Honeywell, Eaton, and other industrials that rely on construction spending. You've also got aerospace. Almost 1/3 of the commercial large aircraft backlog is in Asia. And with India and China's economies growing below prior peaks, there's also risk to those backlog and orders as well.
What about that?
So that's right. Residential spending so far has slowed down, but keep in mind we are coming out of the harshest winter in many, many years. So because of that, there are some lagging relationships that are still developing. So I would not necessarily say that we were seeing a slump in residential construction. I think we're definitely seeing a pause. But I think the other note that I would make here is that it's not just about residential construction. It's about non-residential construction, which always follows with a lag. It's also about autos. It's about appliances. It's about many, many other drivers. For example, energy capex is one of them. So there's many other drivers. And I guess one of the points to make here is that in this part of the cycle, you start to differentiate between economic performance and stock market performance. And in this part of the cycle, you really start looking for those pockets of opportunity. Okay. So I think it's not just about picking the sectors, but also picking the spots within those sectors. So companies geared to perhaps non-residential construction might do better.